Hello, everyone. Happy New Year, and thank you for joining me for Kathmere's 2024 Year-End CIO Market and Economic Perspectives webinar. I'm Nick Ryder, the Chief Investment Officer here at Kathmere. In this fast-paced webinar, we'll quickly touch on the key topics in the global economy and markets that are top of mind for investors today, and I'll share my perspective on how we're navigating them. Let's dive right in, starting first with a brief update on the economy. The U.S. economy remained resilient in 2024, and momentum remains on its side as we head into 2025. Against the backdrop of more restrictive monetary policy and higher interest rates, in 2024, the U.S. economy experienced a favorable combination of strong GDP growth, robust employment, and moderating inflation as economic imbalances diminished and the economy benefited from fortuitous supply side factors. Looking ahead to 2025, the consensus base case among the professional investor and economist crowd is for much of the same: continued economic growth, still full employment, stabilized, albeit slightly above target inflation, and slightly easier monetary policy. Looking to the stock market now, 2024 was yet another fantastic year for U.S. stocks. The S&P 500 was up slightly more than 25%, including dividends, marking just the fifth time in the last 100 years that the market gained more than 25% in back-to-back years. Looking back at the past four instances, we've seen a mix of really good, average, and poor performance. Thus, really the fact that we had two great years provides us no actionable guidance as to what to expect in 2025. Looking under the hood a little bit, it's no secret that the market's stellar performance over the last few years has been attributable to select number of high growth and mega cap technology oriented companies dubbed the Magnificent Seven, which were up collectively 48% last year versus just 10% for the rest of the market. In all, the Magnificent Seven accounted for slightly more than 50% of the market's gains on the year. In many ways, when I look at the market, it's become increasingly bifurcated in recent years. It's really become a market of big growth stocks and then everything else. Below the hood here we see, again, from a thematic perspective, that 2024 in many ways looked very similar to 2023. Once again, we saw U.S. stocks outperform non-U.S. stocks, U.S. large caps outperform their small cap peers, and growth stocks outperform their value peers within the U.S. markets. Again, as I said on the last page, large U.S. tech companies for many years have been the most important driver of market returns, and for valid reasons. Their earnings have far outstripped those of the global market for more than a decade now. However, since 2022, a significant factor contributing to mega cap tech's outperformance has also been widespread optimism around these companies' ability to sustain their exceptional performance, notably by riding the AI wave. This optimism has in turn pushed up the valuation of these companies noticeably higher. The mechanical byproduct of growing share of profits among a select few companies and higher valuations means that the market now is the most concentrated that it's been in about 100 years. As a result of this increased concentration, we now see that the market is strongly dependent on the prospects of a small number of expensively valued stocks. At the heart of the matter, really, for investors looking forward today is whether the superior performance of today's dominant companies can persist over the medium to longer term, something which we'll touch on in a little bit as well. As a result, the other thing we're seeing in the markets, right, as a result of these dynamics that we covered on the previous page, the U.S. stock market in aggregate is historically expensive. We see that today's overall market valuations have only been matched or exceeded during the dot-com bubble and during the height of the market's rally in 2021. Taking stock of where we stand today and what's our outlook for U.S. stocks, a couple of key points I'll touch on. As it relates to high concentration in the expensively valued mega cap growth stocks, the important part here is that it poses a risk to the aggregate market if the fundamentals and valuations of these companies mean revert from their historically exceptional levels. History would suggest that there's a strong possibility this occurs, but it's by no means a certainty that that will in fact occur. As it relates to high valuations, I think it's important to recognize that high valuations alone tell us nothing about the short term. As it relates to next year performance, simply that the market's expensive doesn't tell us anything on what to expect. Historically, we've seen no link at all between valuations and returns over the following year. Absent an economic or earnings growth shock, returns can continue to defy valuation gravity in the short run, right? This is just exactly what we saw in 2024. The market was expensive coming in, and yet we still had a fantastic year. That said, high valuations do leave the market vulnerable to correction. History has shown, though, that the price for high valuations is often paid disproportionately when the cycle deteriorates and optimism begins to fade. Um, and then the last point, which I think is probably the most salient as long term investors, um, the reality is that history does show that there's been a pretty strong, albeit perfect, link between valuations and subsequent 10-year returns. The fact that we sit at historically high valuations today does lead us to have a cautious outlook for the aggregate U.S. market index performance over the next decade. That said, perhaps encouragingly, though, the average stock in the U.S. market does continue to trade at a much lower valuation than the market as a whole, and it could materially outperform over the next decade. That, in our mind, that provides opportunities for investors in alternatively weighted index like a factor tilting or an equal weighted index to potentially capture superior performance in the years ahead. As a point on this, following the last two peaks of market concentration, the one that occurred in 1973 and the one that occurred in 2000, the equal weighted version of the S&P 500, which weights all the stocks equally as opposed to the traditional capitalization weighted version, the equal weighted outperformed the cap weighted aggregate index by about 7 points per year on average over the following decade, from that 1973 and 2000 peak of concentration. I don't think that the next 10 years will look exactly like that, but it is a source of optimism that even were the market to have a below average performance in the next decade, there are still opportunities to capture superior performance in a very structured, low cost, rigorous way. Um, Turning our attention now to non-US stocks, in past commentaries and webinars, I've described foreign stocks as an asset allocator's purgatory due to their sustained underperformance versus US stocks. On this page here, we show that since the start of 2010, when this rally really began for US versus non-US, a dollar invested in US stocks 15 years ago is now worth slightly more than seven today. That same dollar invested in foreign developed market stocks worth $2.3 today. The same dollar invested in emerging market stocks just $1.60 today. When we look under the hood, underperformance in non-US stocks over the last 15 years attributable to three main causes. One is that you've seen superior earnings growth from US companies as they are more efficiently run, more optimized around profit maximization. They benefited from a more favorable policy and general backdrop than the non-US peers. At the same time, non-US companies have seen their valuations expand much more than non-US companies. And then the additional factor from a US dollar based investor perspective, you've seen the dollar appreciate by about 2 percentage points per year over the last 15 years. And so that's just served on a drag on foreign returns, which are an investment in foreign currencies as well as foreign stocks. All in today, we see now US stocks are responsible for about 55% of global equity profits and an even higher 67% share of global equity market value, which is an all time high for any single country around the world. Um, Not surprisingly, given this exceptional performance the last 15 years, this notion of American exceptionalism has become a popular theme in investing today as investors around the world have become convinced that the U.S. is the only game in town and the only place worthy of allocating capital. On the page here, we see that U.S. companies now dominate the ranks of the world's largest companies. However, what I like to point out and worth remembering that the world's largest companies have been remarkably inconsistent from one decade to the next. Look back just 15 years to 2010. The conventional wisdom at the time was that China and a selection of other emerging markets, notably the BRICS, Brazil, Russia, India, and China, were set to take over the world and were a surefire place to invest. 10 years prior to that, it was all about the dot-com bubble and U.S. tech company leadership. And then even 10 years before that, you see the ranks of the largest companies heavily dominated by Japanese companies. The investment consensus, of course, at the time was that Japan was this unstoppable force set to conquer the world, really due to its manufacturing efficiency. The other part of this, and very related to the past slide, is that we need to remember that U.S. Has not always dominated all other markets. Yes, the U.S. has dominated over the last 15 years, as we just covered. It's very instrumental to the recall that in 3 of the previous 4 decades before the 2010s, the U.S. fell towards the bottom of the pile among its developed world peers in the 2000s, 1980s, and 1970s in terms of its performance. So, yes, U.S. outperformance recently, but that, of course, has not always been the case. Ultimately, as it stands today, given the prevailing sentiment foreign stocks trade at a historical valuation to discount to U.S. stocks, really no matter how you cut the data. We show it two ways here. You can cut it in many other forms. The story all tells the same. Foreign stocks are historically cheap relative to the U.S. peers. In my perspective, one doesn't need to possess a significant contrarian streak to recognize that this massive valuation discount may provide some source of opportunity. So pulling it all together, how are we allocating the current environment as it relates to global stocks? As always, we start with first principles, right? It's own the global market passively. Yes, we maintain a bias and an overweight towards U.S. stocks as a starting point, but it starts with owning a globally diversified basket of public stocks. The reason for this is simply that stocks have historically generated attractive returns as a reward for providing financial capital to companies that sell goods and services to paying customers and turn a profit for doing so. Absent a crystal ball as it relates to diversification, absent that crystal ball telling us exactly which markets or economies are going to deliver the best returns, the best thing that we can do to manage risk and ensure that we capture returns wherever they exist is to diversify globally. Again, with that bias towards the U.S., but nevertheless remaining globally diversified. Beyond that, and beyond simply starting passively around the world, then what we look to do is layer in overweights and underweights based on individual investor preferences, conviction, and risk tolerance. For an investor striving to achieve outperformance, one form this could take is then tilts towards stocks with empirically rewarded characteristics such as value, quality, momentum, shareholder yield. As I discussed in the previous pages, foreign stocks may be another opportunity to be slightly overweight to capture superior returns in the years ahead. For investors that are more risk management minded, one way we do that is then tilting and emphasizing companies that have exhibited lower fundamental volatility in terms of more stable revenues, more stable earnings, as a way to gain market exposure, but with some measure of downside protection. And for another investor, it may be simply, I'm looking to deliver after-tax outperformance. The way we can do this is own the global market passively and then actively harvest for tax losses where possible. So a lot of different ways we can allocate to stocks in the current environment. Turning our attention now to the bond market in 2024, broad intermediate term investment grade bonds generally muddled through. They delivered very modest positive performance as yield income was largely offset by price declines caused by the move higher in interest rates. We see that cash and cash-like strategies outperformed, as did two segments where we bias the majority of our clients' bond assets. First being ultra short and short-term investment grade bonds, which are less sensitive to changes in interest rates. They delivered superior performance in 2024 as rising rates had less of a negative impact on their returns. In addition, select other, I'll call it less traditional segments of the short-term bond markets where we've allocated to also delivered even stronger performance in 2024. A sampling of those is shown there on the right-hand side of the page. In the current environment, how are we allocating? I think a few points worth stressing. One is that undoubtedly higher starting yields today have greatly improved the risk-return outlook for bonds as a broad asset class. The greatest downside risk remains the one as it was last year, which is a sharp rise in interest rates. As it relates to our management of bond portfolios, our emphasis is and remains on managing risk first and focusing on upside potential second. And this is really a byproduct of our understanding of the role of bonds in a portfolio is deliver stability and ballast to a portfolio. And it's not always about reaching for the highest potential yield, but rather managing risk first. When we allocate within core bond portfolios, our approach remains the same today as it was over the last number of years, which is we continue to believe that short-term investment-grade corporate and municipal bonds offer the best prospective mix of return potential relative to risk. Beyond the core bonds, we continue to find attractive opportunities to increase yield without materially increasing risk. We think they're available in segments of the short-term bond market that are either often overlooked or deemed too complex by other investors. Some examples of those were shown on the previous page, but it's highly rated securitized bonds, very short-term, higher yielding corporate bonds, as well as catastrophe bonds as well. And then wrapping things up, we just spent a lot of time focused on public stocks, public bonds. We continue to be big proponents of allocating to private markets, really to expand an investor's investment horizon. We continue to find attractive opportunities across private credit, real estate, infrastructure, and private equity. We believe that for investors with a long time horizon, the ability to give up liquidity, i.e. immediate access to their capital, on a portion of their assets. Private markets assets have the potential to increase the diversification of the portfolio, increase the income potential of the portfolio, and increase the return potential of the portfolio. As it relates to structure and strategy, we continue to believe that both the traditional closed-end drawdown vehicle as well as the newer open-ended semi-liquid evergreen structures can play a role in investor portfolios. So with that, I thank you for joining us today. We, as always, appreciate the trust in you place in us and do not take it lightly. If there are any questions, please don't hesitate to reach out directly to me or to your investment advisor. Thank you so much for joining me, and Happy New Year, and we look forward to speaking with you soon.